Wonderful. All right. Good evening, everybody, and welcome to Technical Analysis Part 2 with me, Mike Roding. So, yeah, Part 1, for those that missed it, you can probably still get it through LegacyFX. This is a follow-up on that. Before we start, as usual, we have the risk disclaimer. So let's go through that for a minute. I think that's long enough. Right, so what we're going to discuss today is, well, I'll introduce myself shortly for those that haven't been with us before. And then we're going to take a look at possible market movement. So everything we discussed today is in regards to technical analysis. So we're going to look at how you use technical analysis to predict possible market movements. We're going to look at how that will then tie into how to plan your entry and exit strategies. And then we'll cover on risk management as well a little bit. Because it also has to do with your entry and exit, like stop losses, like lot sizes and stuff like that. And then obviously, as always, we have a Q&A session at the end where everybody's free to fire away. So yeah, about me. So like I said, my name is Mike Rotting. Clearly I do webinars like this, but that's something recently. We'll get back to that. I'm 35. I'm Dutch. I live in Greece. Well, soon to be Dubai probably, but yeah, that's basically who I am. You know, wife, kid, all the fun stuff. What I do is a little bit more interesting. Apart from being in the process of becoming a chartered financial advisor, I am basically a retail trader like you guys. Except I had a little bit of a, some say a lucky streak, but yeah, I happen to have a good 10, 15 years under the belt where I just consistently made profit on a yearly basis, allowing me to build out what I had to a point where I can rotate out of the retail sector and into the more professional investment scene and underlay my money there. So in this trend, what I do is I try to pass on as much of the knowledge that I've built up over the years for myself, the way I have done it. Hopefully that will help some of you to improve your trading and your consistency, in your profitable runs, and hopefully avoid some of the mistakes that inevitably we've all made, but some of the early mistakes that I've made, and hopefully get you on a better track faster. So yeah, we're going to be including charts into this webinar as usual. There will also be interactive moments where I'm going to ask you something, and the chat is open, right? So the question system is open for those that have been with us before. They know. So I'll ask a question. Feel free. There's no dumb answers, or if you don't know, if you just want to give it a shot, feel free. I like to keep it a little bit interactive. Otherwise, it's basically listening to me, and that's about as dry as watching paint dry. So firstly, we need to understand movements. If we're going to determine what our entry points are going to be and what our exit strategy is going to be, we're going to need to understand what the market can possibly do. And we're going to look at this in a short-term trading time frame, which in my opinion is anywhere from an hour to a week, into long-term trading, which is multiple weeks to a quarter of a year, actual long-term setup trading. Now, within short-term trading, I put three little things on the screen for you. Right, riding the wave, scalping, day trading. I'm not going to go ahead and get into different trading techniques like zigzag trading and like fishnet trading and all that kind of stuff. But what we do have time for is first of all, understand the basic principles of the different types within this. So what we're going to see in the chart, as everybody knows, the charts have a tendency to move in a zigzag motion, right? Up, down, up, down, up, down, regardless if it's an uptrend, sideways, or downwards, right? It always has like these repeating pullbacks and pushes, and then the occasional breakout. So how do you benefit from this in the short term? Well, us as retail traders generally don't have the account size required to open up trades and let them run for a quarter of a year. because that's a specific type of trading where you also need to bank and build on these trades and do a pretty broad portfolio type of trade in order to really bank on this. It is the more consistent way of trading because you obviously take less risk, because every trade you open is a risk. So the less trades you open, the less moments you take, which also means you can wait for the more perfect opportunities. But you need to have the capital in order to benefit and really use those opportunities. So within the short term, we're going to have to utilize both directions within a trend to optimize our profit and optimize our possible trading moments. Now, why did I mention scalping? So scalping is one of those techniques that I think is widely misunderstood within the retail trading community. The proper scalping is what would happen if you look at the Wall Street supercomputers that open about 700 trades per second and close them coincidentally also within a second. And they do this 24/7 as long as the market's open, right? So not exactly 24/7, but you get the idea. So, you know, the second that the market opens, every little micro fluctuation is what they grab. But this is without a broker. This is without any, you know, spread or commission because they are trading it directly on the market. This is actually what real scalping is. And for that to be profitable, you need a 99.999% win rate because you can understand it's in, out for really small micro transactions that add up because you're doing such a ridiculous volume. What we can't do is, because it's simply humanly impossible for us, is to do that many trades. And that is why people think scalping is, okay, I go in on a 5-minute candle, I let it run for 3-4 pips and I close it again. The problem is that the risk factor on the opposite side is like you don't tend to close it when you're minus 2-3 pips because you expect it, well, okay, I open in a negative anyway because of spread. So I have to wait for it to go up. But when it spikes down, because you're doing on a small time frame, right, a minute or 5 minutes, 10 minutes, like you don't have the opportunity to close it in time. And because of that, this little bit that you win, where you see people, I win 5 pips or 10 pips or 15 pips, but every time they lose, it's like 10, 15, 20 pips, right? So you never have a proper risk reward ratio. And if it happens to spike at the wrong time in the wrong direction, because you don't set it up with a stop loss, you instantly just negate basically a month worth of trading in one loss, right? So you're trying to do an extremely high volume with an extremely high win rate in a really volatile small time frame that doesn't really have a real proper direction. Now, even if there's a strong uptrend for the last 8 months, let's say 8 years, within that you have multiple minutes going the opposite direction and spikes the opposite direction within a very small time frame, right? Not on a day, not on a week, you're not going to see that, but you see that in the day, right? So it's a very bad technique, and it's more of a technique that people think they can get rich with fast because the duration of their trade is very short. But it's actually one of the more risky trading styles. What is important to understand as well is that it's very high intensity of you putting a lot of effort in for very little gain at a time. So you should never really consider scalping. And that's why a lot of brokers are also not able to allow you to do so, simply because spread-wise and commission-wise, if they have both, for instance, it's never going to be profitable for you because the expenses that you have to make for every open and closed trade is too high for the gains that you're going to get out of it. Right? I hope that makes sense, what I just said. So what about day trading? Okay, so day trading is a very old style of trading that used to be very popular pre-2008 and started slowly declining after 2008. Now, I specifically mentioned 2008 because everybody knew what happened then. Right? That's the day, the year that basically everything went sour. Now, since then, if you look at the average daily movement on almost every single instrument on the market, has significantly dropped in the amount of daily movement. For instance, I used to trade pound yen quite a bit, and you would have 400 or 500 pip candles per 4 hours. Nowadays, if you get 400 in a day, it'd be a pretty miracle. So this is why you hear more, more veteran traders say day trading is dead, and it's been dead for a while. Because again, you're doing a high amount of investment. You're constantly on top of the charts. You need to constantly monitor everything. You need to constantly be busy with everything. And you're really looking for timing in the market within a very small time frame again. Right, still a day is a small time frame. So again, you're trying to pick perfect moments on a multitude of assets and trying to find the right. First of all, you have to identify which asset currently has the money moving in. So that includes, commodities, includes stocks, that includes indices, that includes, the exotics, not just the majors and the minors. So you have to go through all of them on a daily basis and throughout the day. Now, if you're like me, when I was trading, you also just have a job or you have a family. You don't have time to sit in front of a computer for 12 hours a day, monitoring every single movement from Monday till closing on Friday, or Sunday till Friday, basically, right? So again, this is why they say day trading is kind of dead. You can still trade within a day, yes, but not according to the old-fashioned real day trading that we had, right? The gains are much lower. And when we look at, first of all, trading, it should be an investment to grow over a period of time. And we look at longevity of an account. We're not trying to get rich tomorrow. If you want to do that, be my guest. Take any money you have in any trading accounts, put it in your pocket, get it out of an ATM, drive to the nearest casino, put everything on black, and cross your fingers. You might get lucky. Right? You got a 49.9% chance. Go for it. It's not what trading is, though. Trading is looking for a solid, back-testable strategy that will last you in a consistent manner for a prolonged period of time to build your account. Because if you do it the right way, that long period of time is actually in a compound interest style of growth. For the people that understand what that is, you know that it doesn't go as fast at the start, but it ramps up real hard at the end. Right? Because it's percentage based, right? So, and it goes both ways, right? So risk management wise as well. So then we look at long-term trading, right? And how we can use this in different market movements. So long-term trading, the most common one that people throw is like, well, you're swing trading. Not exactly, because swing trading is more the idea that you take a trade when, let's say the market is moving in an uptrend and you start opening sells, but you don't close any of them. You keep building them every time it makes a new high, expecting it to eventually turn, and then you can ride the wave down, eventually passing all your entry points and making all the profits. So you're pre-building on your winners. This is a very good technique if you have a ridiculous capital to allow a very large down draw. And it's a fairly safe trading strategy when you have that, because markets are only able to grow an X percentage a year. If they wouldn't and would explode, the market would crash. So you basically look at certain price points before starting that. That's basically learning where price points are and understanding that, okay, for this year, all the big parties are looking at a potential growth. The fundamental drivers are all lined up that X pair has a very big tendency this year due to A, B, and C for at least quarter 1 and 2 to go that direction. And then you can decide, do I go quarter 1 on quarter 2, or do I go quarter 2 and quarter 3 and then build out in quarter 4 whatever I have, right? So this is really, really long-term thinking trading, and this requires a lot of capital, because if you have $1,000 account, let's say, even with micro lots, you can set this up, but then what are you gaining? You're spending half a year for basically very little gain when it does turn, right? You will win the trades, but it's a very slow way of trading. This doesn't work until you're able to put a standard lot in everything. And so basically really have the ability to not care about $50,000, $60,000 being in a minus, because you can just ride out the wave until it eventually turns anyway, right? That is swing trading. In the smaller retail setting, swing trading is more considered if when you're trying to, it's at the bottom of a channel. I'm going to take a buy, and because this is where it should turn according to my moving averages and Bollinger Bands and Ichimoku and Fibonacci, whatever you're using. You know, my indicators say everything. My technical analysis say it's going to be a buy because it's at the resistance and it's on the bottom of the channel. Okay, but this is not necessarily a swing trade. This is just a proper entry point for a buy because it's low in the market and all other aspects line up with a repetitive pattern that this is the point where if it's going to turn, statistically speaking, it should turn. That's not a swing trade. A swing trade is really looking at where the entire trend turns around for the upcoming quarter of a year. Right? So it has the same conceptual idea, but it's not the same thing. Right? So by essence, it is a concept. Right? So long-term trading as well, if we take a look at, hey, what is long-term trading in the sense of type of trade? The short-term time trades are timing based, right? You're trying to time your trading moment in the market for a very limited amount of time. Long-term trades are more with a mindset of time in the market, understanding that most markets have a fixed period of run. Right, so that's a little bit the idea. That's the basic difference. So this is what we're going to do on the chart, right? We're going to first of all plan some movement ahead. Then we're going to read the chart. I'm going to explain the variables that you see out of this, and I'm going to elaborate on building on your winners. And we're going to also, in this concept, apply everything that I just mentioned before, right? With different scenarios are going to happen. So we're going to do that on a live chart. So I just happened to grab this one, which is the Euro CAD. Now, for those that follow, we always start with a top-down analysis. I see a hand raised, but I can't see where it's from. If you have a question you want to throw in, just throw it in the question box. It should be open. I'll read it in between. As for, so let's take a look at this chart first. So we started a week, right? And we work our way down. Now in this case, this is the first interactive system. I put the basic resistance, okay, so it's the highest point, lowest point, recent. That's relevant to where we are in the market right now. I don't care about this resistance, for instance, because this is a week. That would be a month or 3 ahead, right? So we don't really care about that. So here we go. We have 2 equidistant channels drawn right now, and I distinguished them by color. The initial one that I drew in the same color as the week, and I made a blue one. Which of these 2, the green one or the red one, do you think is the correct channel to draw on a week? Let's see who's brave. Can I make this question thing bigger? Ah, there we go. Brown, green. People getting involved. Cool. I'm just trying to make this thing bigger. Hold on. Ah, there we go. Red feels more responsible. Okay, brown, lower. Green, green. So it's very mixed, right? People say red, people say green. The funny thing is, in this case, it's both. It's a channel within a channel. It's a little bit of a trick one. So in this case, it gives you a little bit of headache because you had these massive spikes after a historical high, after a huge burst. It hasn't really established its new flow yet. So what you get when that happens, this is one of those rare scenarios where you have an established trend, which is the more stable one here, but you have these weird spike outs. So what you need to consider when trading within this is that it can fluctuate within both. So you need to factor in a certain range when trading it, right? So, so here we can consider both. That means that if we look at a weekly, if this week closes where it is right now or dead, right? So we have a dead candle. what will most likely happen is that if the green candle starts on Friday, or Monday, sorry, is that most likely it will just bounce back and then stop at these two lines. So this is one of those moments where we know it's a downtrend or semi-sideways, but currently going down for the last few weeks. We want to look for selling opportunities, but we're low in the market. But what options do we have? Well, it could do another spike to the bottom because that's the spikes that it hit before, and that would be in conjunction with the top side. However, that range is very small. We don't have a good place to put our stop loss because we know that this is a full range that it is freely to move in if it does tend to spike the other direction. So what happens is your stop loss is going to have to be all the way somewhere over here, at least outside of these two lines. And this is your take profit because you don't expect it to break through this line right now, unless it has a breakout, right? Which would be a correction of this whole spike. Then you just got to break out all the way back to the old price. Now you get in this scenario of what, should, could, and if, and now we have to start looking at two other factors that we're not going to discuss now, like fundamental drivers and market ranges and big funds, right? So let's say right here, we're in this scenario. So let's say for scenario, it closes as a dead candle and we start getting a green candle on Monday. Do you wait for the green candle to close on Monday, or do you just basically say, well, it was a dead candle here, I'm just going to open a buy and go for somewhere over here? I go for the top and then close it there and take the sell. Or do you say, I'm going to wait for it to be to the top and then sell? Which one would you personally do? Or would you take the sell now? Mm-hmm. All right, good. So almost everybody went, I wait for it to get to the top and then sell. Okay, so when you have a smaller account and you know who you are, that is the better choice because you are not looking for a volume of trades. You're looking for consistent trades that you can run for long periods of time with the statistical lowest chance of failing, which means that in a downtrend, you want to only look for selling opportunities. Yes, you can buy in the downtrend, but you want to prefer to go with the trend because it's just a safer bet. Right? We are now in the second one. If this one does this spike rotation another 3-4 times, if you would take every single one of them, the fourth one that does break through up and changes the trend, you lose, but you won the other three. Right? So you had 3 positive moments for 1 loss. Losing is not something you're trying to avoid. Losing is something you're trying to control. Some of the best traders in the world lose more than they win, percentage-wise. And we're going to get to that in risk management a little bit later. The ones that follow me in risk management already know. But you only need 40% win rate to have a profitable account, 33.3% win rate for a break-even account on a yearly basis. So if you're losing your account, or if you've lost multiple accounts, it's because you suck at risk management. It's not because you suck at trading. All right. I mentored a guy that had a 95% win rate on his trades, yet he was still losing accounts because the 5% he was losing were about tenfold. Like, it's that simple, right? So in this case, if you would take the buying moment now, you would ride it to the top, close it, and then sell, right? This is the ride the wave principle where you optimize your in and out moments. Right, so now you've transitioned from a small account, you're now a medium to large account where you can benefit from both movements within one channel. And you have the full range. And you always look at a bigger time frame first, a week, because this gives you an idea. You don't have to look at a month because a week is big enough for us as retail traders to look at what we want. We don't need to see 10 years back and extrapolate the fundamental drivers and how much it has shifted. And like, generally speaking, that's not going to affect us because we don't trade in those kind of assets. What we do trade in is things that are relevant to a week. We want to know where are we on a weekly basis, because that allows us to think then for a day. This allows us for a day to think, okay, how am I going to trade the next few days? What do I need to keep in mind during these few days when talking about moving my stop losses to positive, put in a trailing stop, manually trade them, manually close them if certain things change throughout the week. These are all little aspects that you have to keep in mind, and this is part of risk management, right? And then you start going to smaller time frames, right? So you can trade this in 4 hours, you can analyze it in an hour, it doesn't matter. The concept stays the same, right? You're not going to change that. See, because right now we are on an hour, and in an hour we're starting to get this doji formation where it's going to say, I'm going to go back down. Well, that's great, but we know in the bigger set in our head, we already know that even though on an hour it now says me to sell it, we know it's actually, no, we should be buying this. Because I can sell it for a little bit, because what it could do is it could reset to the end of the day, right? Dead candle, which is we would be making a sell for 36 pips with a risk that you can no way avoid being in the risk zone, because this is the risk zone, right? It can easily spike within a weekly range because, I don't know, a meteor hit something in Canada, or they ran out of maple syrup. Name something, right? So something like that, and it spikes, and it will spike past that point, right? So you want to take a buy, it's just a safer bet, and not what an hour tells you, or 4 hours, like, hey, I should be selling this because look at what it did the last 4 hours. Well, if you had a buy, then this was your last 4 hours because this was the start of the day, right? So let's go back to a week. So very basic on this, we now have one scenario that we know. So I'm going to, can I put this as a default in here somewhere? No, okay. Well, I hate it, it doesn't have airline in here anymore. Bring back mt4.com. So let's make this line. So we expect it to do something like this. Now within this uptrend, we can actually determine roughly what the angle is that it would take, because you can take a look from the last time that it went from top to bottom, and it's going to almost every time match that range. Right? This current particular pair has inside its downtrend corrective spikes upwards roughly between this and this angle. So let's take this one for example. So that's option 1, to which afterwards it would most likely do one of two things. It either breaks out upwards to retest the top and make a triple top, or a solid double top if you want. So that's option, this is, let's make this red, because this is where we lose our sell. Right, so no, red is 2 because everything is red. Let's go blue. So let's make it blue. Blue is bad, right? So we'll go that way. That's a breakout. That means that if we take a sell here, we lose. All right, well, shit happens. Next one. So what is it going to probably do when it gets here? Well, probably move sideways and then move down anyway, because it's more logical for it to do that than spike up, because look at where we are market price wise. Like we legitimately have to go all the way back to pre-2008 to go higher, with the exception of early 2000s, 2016 highest point, right? So this would be almost a historical high apart from pre-market crash. The probability of it going up past that point is much lower than it going down, right? So we simply by thinking logically, I don't care about any indicator that you have, simply by logic, it's more likely to start going down, because the bigger funds are looking at it going down than it is to go up, right? It really is that simple. So that's scenario number 2, right? So it gets there and then it probably will bounce off, and then, you know, it can do a multitude of things, but let's for scenario just go, it will go something like this. Option number 3. It will do what we expected it to do. It will do this. Now let's see what the average angle for that is. Yeah, this one's steeper, but that's just after the correction. So that makes, you know, that's like correction into up into correction. And then it started slowing down a little bit. So here from top to bottom, it's something like this. Here top, it hasn't done the bottom. Roughly this. Yeah, a little bit steeper. So yeah, something like this. It doesn't have to be that narrow. It's just for you to have an idea what it roughly could do. Because so that would mean something like this. And blue's for outside, this is for inside. Inside is gray. I hope this is visible for everybody, by the way. If somebody could put that in the question thing, if you can all see this okay, I would appreciate that. We can't zoom in too much because then everything goes out. All right, perfect, thanks. So we have scenario 1, possible breakthrough into scenario 2. Obviously, we could say, like scenario 3, it breaks out over there. But we've discussed that scenario, and it's very highly unlikely, besides from the point we've already lost our sell, and we're not going back in at the moment anyway, so it doesn't matter. So 1, 2 scenarios. So both, you know, solid selling. This would be actually the optimal one to sell if it does do that, but we would definitely wait for a consolidation phase or something, right? It needs to shut underneath this line for the week, and then we just go, because every time it's done that, closed under the week, closed under, closed under, closed under, closed under, closed under, closed under. So it always goes back down, right? So we will wait for a confirmed candle that closes underneath this line for whatever week, and then we will just go for the sell then, right? If you're feeling ballsy, go in before, but then you might lose. If you've taken this one, you might lose twice in a row. So in this case, patience is a virtue. Here, you should just go in. But I would just go in, because statistically, it should just do that. Yeah, if you look at different pairs of CAD, you're gonna have similar charts, right? But we're gonna look at a few charts, don't worry. Obviously, I have some limit in time, but I'll try to do a few charts, because we also have a bunch more theory to do. So from this point, we have another scenario. It either bounces back up and then follows the blue line, basically, because this is the point where it would actually kind of bounce into this. If we extrapolate this a little bit. Yeah. So here you get close to this line and you have your weekly resistance there. At that point, it's a resistance because resisting the upwards. So it'll probably stop there and not quite hit this, or maybe spike to it, right? Like you get a needle like this, but it won't go through. So that's 2. And now we have another line option. Now we go into a different trading scenario. And then it does this, where again, same criteria meets, is you're now getting close to this resistance, close to this line. So it's going to start losing speed because you now have 2 price points to get through, right? A price point and a resistance of the bottom of the trend. So here, let's make this one scenario purple. Is that visible? Yeah, that's okay. Right, so now you've basically plotted out, apart from one little alteration, you've plotted out the possible scenarios. And the last one's this, right? That it just goes down now, and then you basically shift this whole pyramid to the left, but you start here instead. Right, it'll probably bounce off of this and then correct itself. That would make sense. This would be a blind buy for me when it gets here, because the chance that it breaks out all the way to the bottom is fairly low compared to it first correcting and then trying to do that. Right, think about consecutive selling weeks in a row. How long are bigger parties going to hold that sell before they want to cash in to secure the profit because they have dividends to pay out? Something people don't think. People always think just, the randomly it moves. Yeah, no. You saw what happened when Elon Musk throws a few billion into the market. Things start moving. Now, of course, when you have enough funds to move the market, because you have a larger share in it, you can make the market move. So the bigger parties, the bigger funds, that's what they do. They don't lose because they put so much in, they make the market move almost. Except this is under very regulated environments. It's pretty tricky, but we're not going to get into that now. But so we're going to get, no, we have these scenarios. So now in every single scenario, the sell is just the more predominant moment to take, right? The more dominant direction. We've also determined our entry points already, because every single point where the line crosses, that is our entry point. Coincidentally, our exit point when we get to the bottom. It is that simple. And when you get a deviation in the fundamental drivers, so when it fundamentally changes, that would allow the market to actually change because of fundamental reasons. Technical reasons don't exist. Technicals are just a way to identify what's happening, to visualize what's happening. Markets move on financial drivers, not on a line on a chart. There are price points, which is a fundamental driver. That's kind of what resistance and support is, right? You're identifying price points, right? And some have more value than others within the banks, within the trading. But what we are determining is that, okay, so now is a entry point for a buy. You would not take the sell because this purple arrow is very short compared to the potential buying moment. And although even it could bounce off of this, then go back down, that's a scenario we haven't drawn, right? There's small micro ones in there, but these are the bigger lines, right? Big picture, this is what it should roughly do. One of these options, it either does the purple one, the gray one, or the blue one. It really isn't going to do anything else. If you look at the history and you draw these lines, there's a few online charts that you can use where you can erase the past and then draw, and then you can make it like go live again. So you can go past and through it. Just do this as a practice there, and then turn the live chart on again so it goes through your lines to see which one it follows. And apart from a few exceptions where you're going to get, like I said, fundamental driver or a news announcement, something screwing it up in between, right? You're going to get a different deviation, but usually it's only a deviation for a small period of time and just shifting things around. And meaning shifting, it like either accelerates what it was going to do or decelerates and slows it down. And in worst case scenario, it turns it around, right? You go from a down to an uptrend, for instance. Well, that was a trade you were going to lose then, and that's okay. You don't care about losing trades. You need to learn yourself to not care about losing trades. I know that sounds really stupid, but you have to accept you will lose trades. Once we get a little bit further into this webinar, you will understand that it doesn't matter. Because if you would take, you know this for a fact, if you would take every single opportunity that it is at the top of the channel, every single time, with every single chart, with every single currency, you will win the majority of the time. But you're afraid for that time that you're losing. You shouldn't. You really, really shouldn't. Because you have your entry points. You just identified them. You identified the direction the market could move, and with that, you identified possible entry points. Oh, wait, I have this chat thing in the way, right? So we went to plan the movement ahead, and now we're going to read the chart, right? But we already kind of did that because I color coded them for it, so it makes it easy for you. But we know we have 3 different scenarios, roughly, of what it could do. And we understand that historically speaking and currently, selling moments at the top of the channel is the most ideal entry for me. especially when I have a small account that doesn't have a lot of room. That is what I'm going to wait for. If that means I have to wait 4 weeks for this goddamn thing to go up, I will wait 4 weeks before I trade. And this is one chart. If you would go through every single euro pair and every single USD pair and every single, and you don't have to do that in one day. You don't have to do it in a week, right? We're talking about a weekly time frame we're doing this in. That is the primary one you should be doing, and then you can work it down to as detailed as you want. But generally, I would recommend not trading under 4 hours because you get too much. See, because we planned this out, but if I switch back to 1 hour, this makes absolutely no sense. Like, it looks like it's really volatile right now. It's not. It's barely moving. But if I go to 5 minutes, oh my God. Like, it's breaking out. I've heard some people tell it to me. I went to 1 minute and I saw it break out. What? Did it? Really? And then I go to the chart and I'm like, I don't see anything. And then they're talking about, oh, wow, 10 pip movement. Whoop-de-doo. Thanks for waking me up for nothing. Like, you should not be happy with any trade. Nah, that's not fair, because depending on the chart, but basically under 200-300 pips, you shouldn't wake up for it, because you're wasting too much time on something that's not going to be profitable in the long run. But you're going to have different charts move different much. If you're doing Euro CHF, if you get 300 pips, you're a god, because the thing moves like 50 pips a day. So you'd have to be really good, right? But it's relative. Most pairs in the majors, and you talk about like between 100 and 300 pips in a day. So yeah, like I said, you work top down. I'm now doing it on a week because we won't have enough time to like go all the way down. But yeah, I usually start on a week, then in a different color, draw in my blue trends and resistances like I did in part 1. And then in 4 hours, you make a little bit of a nitty gritty, because on the day that you're going to trade it, so let's say we're here in 2 weeks time, on the day you're going to trade it, you're going to look at the 4 hours, how the candles are developing, to see if the momentum is slowing down, which usually indicates that it's about to turn, which gives you a possible opportunity to already go in, but never lower than that. So this is really something I only do when it's there, when I want to start moving. Other than that, once the trade is open, I generally tend to look at a day or a week only, because I don't care what it does anymore in between. Right? So, right, if you would be a small time frame trader, right, you're sitting here at 15 minutes, you'd be selling right now. And you'd be looking at this, right? You look at this trend, okay, I sell, I go out here, I'll buy, like, your stop loss should be over here, but you're not going to trade with a stop loss. It's 35 pips. Your take profit is over here, which is 20 pips. You're in a negative ratio. You're risking more than you're willing to make. It doesn't make any sense. And you're not going to go in here because you don't have a price action confirmation, really. Well, sort of a doji, but like, doesn't make any sense to short it here. You wait for it to get to one of our scenarios. If it gets here, we buy it. If it gets here, we sell it. If it gets here, we sell it as well. Right? So that's understanding and building on your winners. So let's build on our winners for a second. There we go. So what is building on your winners? Well, let's take a scenario a little further down the line where we've now in this trend, and most trends last for like a quarter or for a month or so. So you're going to have a few opportunities to do this. Mostly it's like 4 or 5 times that you get these opportunities before it starts changing. Sometimes longer ones take longer, but they usually have like a predominant half within a channel that they're going to stay in, either 80% below the lower half or 80% the top half, right? So it depends a little bit, but if you read the charts, that will make sense then. This is a fairly young trend, obviously. So, let's say we buy it here, we sell it because we know we want a short position over a buying position, preferably, right? That makes sense. So what happens then? What happens next? Okay, so we take a sell. It stops here. Perfect. Exactly what we want. So exit strategy. Do I want to go out here and take profit? Small account, answer is yes, 100%. Bigger account, no need. I go back up. My entry is here. Why do I risk it going back up? It doesn't matter. Because I'm going to take another selling moment whenever it gets here. Now I have 2 cells open. It starts doing this again, because statistically it should do that. Now, when it gets to a certain point, because now we're going to start extrapolating this way, right? So we get to the bottom here, let's say. I have 2 cells open and I'm on the bottom here. Now I would probably close both of them in this scenario. However, if it does this, 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 and then this, and then this, I have 3 because I'll go in back here as again. And what happens is when I go in here, my stop loss is going to be here. My stop loss is going to be here somewhere because it's outside of the channel at that point. This one is going to have a stop loss at 0, and this one's going to have a stop loss at the same level. You move the stop losses with each other, and this is how you build. So when you have a smaller account, you start with a small risk because your risk reward ratio is a little bit bigger. But let's say for a scenario for easy, we start with 1 mini lot, right? So mini lot here, mini lot here, mini lot here, mini lot here, and eventually here it like goes back and hits your stop loss here somewhere. So the 4th trade we lose, the 3rd trade goes out at 0, and 2 trades go out and a win. That's 4 mini lots total. 2 of them are profitable, 1 of them is neutral, 1 of them is a loss. Now here's where the importance of risk reward ratio comes in. If you did that properly, each trade that wins should be roughly a third, 3 times the value of a losing one. The second one is going to be about double the value of the last one. The first one's going to be about 5-fold the last one because your original ratio is this, but you're now looking at a ratio over here. So when you go out here, you have 1 neutral, 2 winners, and 1 loss. But in reality, the smaller win negates the loss plus a little profit, and the 3rd one is pure profit. Now, if you have this in a prolonged period of time where you get something where it's going to correct back downwards, you can understand what happens then. You do this once, and you'll have 10, 15 trades all the way at the bottom, and that's it. Now, that happens extremely rarely because you're basically entering at perfect swing trade moment. But by doing that technique, when you do start identifying it's very stable in the trend and I can write this, then do it. Because your trades secure each other by moving the stop losses. If you're better, this is again to look at becoming even better. This is more advanced when you want to be more consistent and maximize your profits, maximize your opportunities. When you're at the starting point, you're going to obviously sell, close, wait, sell, close, wait, sell, close, wait, sell, close, wait. Then the second stage is sell, close. So sell, close it here, buy it, close it here, sell it. And then you start doing, okay, I just do the long run and I do buys in between to also benefit of that. So now you literally take everything and you build your short-term selling opportunity into a long-term selling opportunity by building it by small increments at a time and not putting 10 standard lots as a sell here and praise to whatever it is. I hope that it works out, right? Because you're taking too much of a chunk of risk in one go. You're basically spreading your risk, right? And now on top of all that, you're also obviously going to trade in different charts at the same time, controlling your exposure, yada, yada, yada. Right, so not 10 trades on euro, ladies and gentlemen. I've seen that way too much. Or 8 trades on US dollar and 3 of them are against and 4 of them are with and 2 of them are going nowhere. Like, you spread out your risk. Build a balanced portfolio of trades. When you start, yes, you're going to be doing 1 trade at a time. But when you've been trading for a year, you should really already be at 10 consecutive trades at the same time at any given point. And your portfolio can easily have that if you're trading with a percentage, right? So Let's take our next thing. So I already touched on this a little bit, right? Stop losses. So when do you use fixed? When do you use a moving one? And when do you manually adjust them? Does anybody have any idea on just rough when I would use a fixed one? What is this, in what scenario, what stage of trading, I should say it actually, let me make a little bit of a hinty thing. At stage, maximizing gains, okay. At what stage do I use a fixed stop loss? Perfect, thank you. Johan, you're right. Oh, keep in mind, by the way, by fixed stop loss, I mean one that is not going to move when the trade moves, so not a trailing stop, right? A fixed one is also not a fixed amount of pips or value. Oh, actually, no, pips. Value, yes, because you're using a percentage of your capital as on every single trade. And more riskier trades, for instance, against the trend, you take a smaller percentage. But yeah, it's right. You use it at the start when you open the trade. So to put that in perspective in an actual chart here, and I'm going to keep using this chart because we're almost at the hour and we want to have Q&A time as well. So what we're going to do is you can't hear anything. Is anybody else having issues with hearing? I believe everybody can hear me fine. Okay, I'm afraid Steven's going to have an issue then. Okay, well, I can't fix it for other people. Okay, so let's take this scenario here, right? Let's go up, right? Now I take my selling opportunity. Now I'm going to also have my daily, analysis done. Obviously, when I'm close to this, I care about the week. When I'm close to that, care about the week. In between is somewhere is the day. For scenario, I'm just going to take these two. I can't see because of this thing. So what was the rule again? At least 3 or more connection points? Yes, good job. Thank you. 1, 2, 3, 4. Yeah, this is fine. So this would be roughly a daily resistance for the uptrend. Let's make that blue. Okay, so the blue one is the daily. So let's say we're up here. We're close to this. So we're at this trend line. And then we see the next resistance after this bluely is probably somewhere over here. 1, 2, 3. That one is more of a week. That's more related to the channel. Yeah, so that's one. Roughly the same distance, right? Which is also repetitive. We know that, right? Price points have a repetitive distance. And the higher you go into the market, the more squash they get. The lower you go into the market, the more squash they get because it needs more and more push in order to go further. And then there's a safe range where everything is basically equal to move. Right? Think about that for logic when you understand how money works. Makes sense. All right, so anyway. So now we're in this scenario, and I'm trying to get that to be more centered. Oh shit, that's way too small. All right, so we're gonna have to bear with this, people, sorry. Let me just insert a circle thingy here. Hold on. Bear with me. Sorry about this. Eclipse, let's try that. Boom, boom. Boom, boom. Oh, come on, work with me. So we're in this region right here in the circle, right? So let's say my entry point at this point is let's say I'm really good, I'm a god. I'm gonna go right here, and I have my price action. Everything is confirmed, right? Actually, we can keep this thick. We'll just make it entry point color bright green. Oh Christ, that's way too bright. Do we have a grass green kind of color? Yeah, there we go. So the green line represents my entry point for a short. Where is going to be my stop loss? I'm going to give 3 scenarios. Option 1, just outside of the trend line. Option 2, outside of trend, outside of nearest daily resistance. Option 3, outside of everything. Which scenario, if my entry point is at this one, where would you take the stop loss? What do you think is the correct one, risk reward ratio that we're going to be looking for? Mm-hmm. Mm-mm. Oh, yeah. All right. So luckily nobody said 3 because although that stop loss is not wrong because, you know, it's way out of range, there's no reason to take that much risk because if the trade goes there, you should have been long out of it because it's basically a losing trade. Like there's no reason to hold on to a trade that long unless the aforementioned strategy is long-term swing trading and you're expecting a shift of the trend, which we already discussed. As retail traders with our measly $10,000 accounts, we don't do that. We don't have the range, right? There's only very few retail traders that have a budget that do that. And when they're doing that, they should actually be trading in something completely different. That's beside the point. Yes, option 2 is actually the correct one. The reason option 1 is actually not right is because we're still within that range and it could spike in a day to the daily just through these 2 weekly lines just to nip it. And that gives you that scenario where you go into a trade, it nips your stop loss, and then all of a sudden it does what it was supposed to do and take that sell anyway. And now you're banging your head on the wall for the 18th time in a row because, oh shit, my stop loss was too tight. This is the correct scenario. And the reason for that is that if you would take this trade, again, we're talking about consistency. This is not like, hey, it's not going to hit it. No, occasionally it will hit it because of a spike or whatever. But consistently, if you do this every single time this way, the majority of times it will not hit this stop loss and will go towards your take profit. It's all about consistency and sticking to the same trading strategy. It's this basic step I've taught so many people as mentoring them so many times. Just this little fact changes them from losing their accounts to winning their accounts. Just doing this, I haven't even taught them anything advanced. But a lot of people try to run before they even understand how to crawl. So this is the basics, right? So now we've established our stop loss and our entry point. Now that we have determined our stop loss, we can measure the distance between our entry point and our stop loss, which is 95 pips in this case, well, 96. 96 pips, 100 pips, 200, 300, 400 pips. People go like, geez, these stop losses are huge. I usually do like 30, 40 pips. Yeah, A, that's why you're losing so much. And B, it's just pips. They mean absolutely diddly squat unless you put a lot size against it. It is a number, not a value. Your risk management determines what the value is going to be. If in this scenario I have a trading account of what's the average nowadays, 2K? So let's say you have a $2,000 account, or euro or pound, whatever it is. Let's say $2,000. And per trade, your risk level is 5% of capital. Somebody mathematically inclined to tell me how much that is? What's 5% of 2,000? Trust me, that people are having struggling with this. That's what I'm asking. Yeah, thanks, Kevin. Yeah, you're all right. Good. All right, yeah, so it's 100, right? So we now determined we have a stop loss that is 96 pips, and we have a risk acceptance level of 5% of capital. Now you already understand why you don't need high win rate, because if I am negative on my account and I still do 5% per trade, that 5% is value-wise less and less and less, but it's always 5%. And if my risk reward ratio is at least 1 to 2, with a preferred 1 to 3 or more, one win will negate not only one loss, but it's incremental, ergo it negates about 4.5 losses and then accelerates from there. So when you're having a bad streak, you will climb out of it in 3 wins. 4. Let's say if a bad streak was 10 losers in a row. On the 4th winning trade, you're back up to square one plus profit. That's why you shouldn't lose an account ever again. All right, so we have the 5%. So what lot size? Anybody know? Yes, I know about variables. I don't care. Just take the flat rate. Standard lot is 10. Mini is 1. Micro is 10 cents. What lot size are we taking this trade on? Stop loss was 95 pips. We have a risk acceptance level of 5% of $2,000, which is $100. And we will now open this trade. What is the value of my stop loss at what lot size? Come on, it's got to be somebody to know that. Thank you, Kevin. Yeah, it's a mini lot. 1 mini lot. So 0.1 is the lot size that I will open this sell on. And now people go like, yeah, but you don't know what your take profit is. Okay, do you care? Do you really care about more money, or are you trying to control your wins, or are you trying to control your losses? The only thing you're trying to control and trying to mitigate is how much you lose. Right, so if we say we have a 5% risk of capital on our trade, that doesn't matter, right? Your preferred is 1 to 3 or more. So if right, so here whoops, not the grid. So when we are trying to determine here, we already know. We go back to a week, boom. We now have our entry point. We now, oh wait, why is this so squished all of a sudden? Hold on. Oh, there we go. So here we've determined our entry point. Possible take profit number 1 is 340 pips, which is 3.4 times our risk, right? That's our take profit number 1. And usually you'll take it a little bit less because in case it doesn't quite go there. So this would, in a smaller account, be your trade. This is how you would set it up. And this is my next answer to you. You don't look at this chart until it closes itself. Or a fundamental news announcement changes the scenario. And this is where we come in with the following. Whoops. I'm sorry, I have this chat thing that you can't see. Moving stop loss. So the manual adjustment happens when a news announcement comes in and you are in profit, not enough profit to basically set up a trailing stop, not enough profit to really justify closing it because you're under the risk, so you shouldn't be. But what you can do is you can move your stop loss to the 0 line to at least secure that it doesn't spike in the wrong direction for you. You go out, that's a shame. Wait for the news announcement to finish with its volatility. And then if it settles again down in the same level that you went in originally with your sell, just open the trade again. All you've done is wasted some time. But it's better than risking it spiking to your stop loss and then having to go back in. Right? Not losing and not winning. So 0 is also winning because you're controlling your loss at the maximum amount. You didn't lose. You just wasted some time. But luckily, time is a commodity we have plenty of, well, most of us. You don't, when we talk about the project is going to last about 10 years, right? By then, your trading career should be roughly over if you're consistent. 10, 15, 20 years of trading, you should be extremely, extremely profitable at that point. Enough to have enough for putting it into a pension fund or saving, whatever. Or multi-asset funds and really go with the big guys now. Right? So moving stop loss, what I mean by that is a trailing stop. So what I generally advise everybody to do, because we don't trade, we're not in front of the computer all the time, you don't have time to do that. Please, for the love of God, don't do shit on your phone apart from looking at where your trade's at. Anytime I hear any of the people that I enter, if I hear them say like, yeah, no, I use my phone to trade, I want to book a plane just to slap them in the face. That is the dumbest shit I've ever heard. You don't trade on a phone or a tablet. Get yourself a decent screen. So at least a 17-inch laptop screen for the very least. preferably a proper monitor. So you have a good solid overview, can look at everything, have the room instead of like fidgeting around on this little 7.5-inch little touchy screeny thing, trying to fiddle things around. Don't do it. For emergency to press close trade, sure, but that's pretty much the only thing you should be doing on it. So in this case, we have a few scenarios. Well, first of all, when we look at this trade, it's actually really simple in this one, because when you start going down at this point, when you reach the weekly resistance, you're 120 pips in profit. You should not be losing 120 pip profitable trade. So if we look back, it can't spike up straight away. So it's going to go somewhere like this. It's going to hit here. That's your entry point. This is where it's going to go. So it's going to back to a daily, and you have the 2 channels. So it should never go back to your entry point at that point. You can put an alarm. Yeah, you could put a voice alert. But what you should do is simply just calculate this. Okay, so this is the first trigger point where I can flip and turn back for a bit, and then maybe do scenario blue. So that's 130 pips, or 1,400 points, let's say, for easy. I will put a trailing stop on my trade for 12 or 1,300 points. Remember, they're in points, not in pips. So when you go to trailing, you right-click your trade, trailing stop, custom, points, 1,200, 1,300, 1,400, right? It calculates the micro pip that we don't use. So that's 1,400. So what happens now is your trade goes here. This scenario doesn't happen. It actually flips into the blue one. It goes back here, and then it bounces off of this and corrects the gray line. So you basically have this breakup. It kind of this shifted down to bouncing this, right? That's the in-between movement that we could expect. So it goes back here. You don't close the trade because your stop loss is now here, like under your entry. You secured your trade. You can't lose it anymore. Worst case scenario, it goes out at 0 or very small profit. At least you have your expenses paid for. But it already needs to go through the trend, both trend lines to get there. And then it bounces off. And look, now your trailing stop just follows it around, and it just goes past your entry point to wherever it is. All right, hit your take profit, and your stop loss is over there. So now in this scenario, let's say it just misses, if I'm over here where my cursor is on the blue line. Let's say that's where my stop loss now is, and it just missed the take profit and pulls back. Then I've secured this entire part. Right? I've still secured my 200 point pips. Sorry. Right, so that's still winning. It's okay if it doesn't hit the take profit, but in general, and that's why you see this, it should hit this take profit eventually. And this trailing stop you only set up when you see that when it's here, and it pulls back. If it doesn't, you cancel the trailing stop and just manually move it under 0, but just let it go so in case it does do that pullback and then do this, so it doesn't go out. This is a case-by-case scenario that you're going to have to get a feel for. Take a look at the charts. Look at how often it spikes back. CAD has a tendency to spike around a little bit. So there I would recommend against the trailing stop in general cases, because the spike might hit it. But when you're starting as a trader, do it anyway. It's better to go out at 0 or slightly less profit. Learning to do the full run profitable trades, which will create you that consistent trading, will happen down the line automatically as you get used to just trading with confidence, right? Trading with the system, okay? Exposure. Okay, so we've covered exposure, right? Like I explained, not 10 trades on euro pairs, and or have 5 trades on the US dollar at the same time. Like everything you have open now is related to the dollar. So anything happens, Bernie Sanders falls over from old age all of a sudden, which wouldn't be that far out of the picture. Yeah, all of a sudden the US in crazy, everything stock, crash market. You know how Americans are, everything starts sell. Yeah, okay. There you go, 5 trades down the gutter. Unless you happen to have a sell, good day for you, but you're taking way too much risk. Everything rides on that dollar going in your favor in whatever direction you're going. Generally not a smart idea. And yes, you can use your risk portfolio to also include indices and or commodities. Right? But just generally speaking, when you have a smaller account, and again, small as anything under 10,000, you should not be trading commodities, generally speaking. Simply because they move too much and the reward ratios, they work a bit different. You have to trade them slightly with a different eye. It's literally more timing in the market, right? More time in the market, sorry. Like a lot of people ask me about Brent and the other things. Yeah, they're going to go back to 60, 70, or $80 a barrel. And I said that when it was at 30. We're now at 60. Like, of course it's going to go there because that's where the producers want to have it. And they have the benefit of being able to close a factory, which changes the supply-demand ratio. Ergo, they can manipulate the prices that way. Anyway, lot sizes. Okay, so we just discussed lot size, right? You never use a fixed lot size because I heard that's a beginner mistake as well. I use a fixed lot size. Yeah, okay. Don't get this the wrong way. That is stupid. Every trader is different. You should be using a percentage capital of risk on every trade as a fixed amount, because that way you can never have a losing account by always risking a percentage of your account and not risking a fixed amount of the account. Because now you're creating a linear loss profit model instead of a exponential profit model. And the one is introvert, the other one is extrovert. You don't have to do math, but I'll get to Bitcoins in a minute, buddy. Cutting your losers. Yeah, that's quite obvious. If you have a trade that hasn't hit stop loss yet, but it's been hanging around in that, down draw for like a week or two, it's just going sideways, it's not going anywhere, it's not doing what you expected it to do, stop waiting around, just close it. If something in the market changed and it now like lingers and it could potentially break through and get into a really weird position, it's actually trading outside of the channel, but it hasn't moved yet, it will eventually. It's probably because the bigger funds haven't decided on yet what they want to do with it or how much they want to do with it. So just get rid of it. Get rid of your losers, take the loss to the chest and move on. You have plenty of other trading opportunities to cover that expense, as we discussed. Proper risk management is all you need. Which brings us to everybody's favorite moment, is hammer the guy and that's talking. So yeah, Q&A time. Everybody fire away. Try to keep it as related to the technicals as possible, please. But obviously I'll try to answer everything. I had a first person that asked me the thoughts on trading Bitcoin now or in the future. If you mean about if you should buy it now or in the future, the answer is future. I'll explain to you why. Bitcoins has a fixed amount of coins that you can have in the market at any given time, as any currency should be, because otherwise it'd be like endlessly printing money, which devaluates the currency. So Bitcoin has a cap. The majority of the current Bitcoins in the market are owned by a few very large investment funds. These have a contractual obligation to eventually close these positions as they need to pay dividends. So eventually this will drop. What I expect it to do is drop to about 15 to 20,000, thanks to the additional 10K spike that it had. But it should have been about 10 to 15, but it's probably going to drop back down to like those numbers, like let's say around 20 grand. And then it will be going up again because that's a new purchase round. And then what I would expect is that it will eventually cap within the next 5 years at 120,000. I hope that answers your question, but that's my expectation. And that's also a little bit in line with what, if you look at the key strategists of JP Morgan and stuff like that, they're all looking at it the same way. They disagree on the actual level, like 120 to 170, but yeah, that's roughly the flow. So I would just wait for the drop, which is inevitably going to happen. It could be this year, it could be next year, but just wait for it and then buy it because you can get into it cheaper than current day price anyway. So next question is a good one, Kennedy. I have an account of 250 and another one of 2,000. Why should my trading be the same? Because trading in its essence doesn't matter how much capital you have. The 251 should really just be liquidated and put into the 2001, to be quite honest with you, because you need capital to set up multiple trades. The only thing that you're going to have a difference in right there is not the way you trade, but the availability of trading opportunities you have at any given time. The more capital you have, the more you can spread your risk, the less risk you take. Your strategy should be the same on every single account, and it's mainly geared around your risk management is always going to be the same, because every single major trader trades with the same risk reward ratio system in mind, and a compound interest rate concept, right? So the lower my account gets, the less risk I'm taking, because I'm taking a percentage of capital, and the higher it gets, the more I'm risking, because again, I'm taking but it's a fixed amount percentage. Ergo, it grows exponentially, but from that point. When talking about the opportunity, you can understand that if you have only $250, you cannot trade 3-4 things at the same time, because you simply don't have the capital to enable you to open these positions. You'd be doing it for pennies. You're not going anywhere anytime soon. Right? It will take you 5 years of trading to get like to 5 grand, and then you can start trading. And that's fine if that's all you have right now. Don't get me wrong, guys. If that's all you have $250, all you can expense, right? That's okay. But be realistic on what's going to happen. You're not going to turn $250 into 20 grand by the end of the year. It is not going to happen. The risk you have to take to get that done is so ridiculously high. The probability of you losing the account versus making that happen is abysmal. That doesn't mean it hasn't happened. Of course it's happened, but that's the exception, not the rule. The rule is, or it used to be, it's slightly dropped because people are starting to smart up a little bit, but there's a saying called the 90-90-90 rule. Anybody ever heard of that? Does anybody know what that means? So within the retail brokers, it's something on the Salesforce, they set 90-90-90. Statistically, in the past, 90% of people that open an account lose 90% of their capital within 90 days of opening the account, without them telling them what to do. It's just people trading on their own. That has slightly dropped over time. People are getting more educated. They're having access to webinars. They're trying, they're starting reading books, looking what others are doing. So that has dropped a little bit, but it's still like well in the 80s. Majority of retail traders that start their accounts lose probably over, the entire account, because in Europe, if you're in Europe, you have a 70% margin call, right? So then you get zeroed out, right? But probably 80% still lose that 70, you get that margin call within 90 days of trading. And the funny thing is, you think they'd learn, but that happens with every account they open after that. They keep doing the same thing, expecting a different result, because they saw some guy sometime do it, or they heard it from this guru or whatever. There's plenty of licensed traders from ex-licensed traders not ex-licensed traders, ex-traders that are licensed that used to have academies, that you can get their number and you can call them. You can just ask or send them an email. Like, don't know if they're going to answer you, but like every single profitable account that I've met of a trader that's been trading for over 10 years, that's consistently profitable, we all do the same thing. We do our trading slightly different. We have different opinions on what the market is going to do. We have different, in the long term, obviously. We have different opinions on why things do what they do. But in essence, we all do the same thing anyway. And that's controlling our risk, and that's doing our management. And it's like, yeah. Right. So And yeah, the majority of retail traders are literally just dumping money into the market, funding the big machine. And it's a necessary evil because without those people, the machine would stop working. And then the whole thing falls apart, right? But that sounds unethical, but it's like a necessary evil. And even if I teach all of you that are here today, and you all magically learn how to do it right and never get greedy and never screw up anymore, it still wouldn't matter for the masses. Because majority of people are too stubborn, too proud to ask for help. And think that they're going to find the golden egg on their own. If there was a golden egg or a secret way or an inside trade thing, I would tell you right now, but it doesn't exist. There's no such thing. I used to be in touch with a fund guy. He was a multi-asset fund manager for a larger corporation that most of you will know. I can't name anything, obviously, but his win rate was 48%. And he had one of the most profitable accounts as a multi-asset fund. All he did was control his losses. He would literally throw darts at the door to pick a direction on something. Like there were some scenarios where there were sideways movements. He would literally just throw a dart arrow at a door. And if it hit the up arrow, he would buy it. If he hit the down arrow, he would sell it. Like, it was literally that simple. They're not super gurus. They're not anything else. What you need to understand from bigger asset firms, like a JP or like Goldman, what they have is they have a very large team doing analysis on a multitude of different angles for them. We, as retail traders, have us and Google, and obviously a few news outlets, and there's some public reports that we can read. That's the extent of what you can do. And there's only so much information you can process and properly analyze in detail in a certain amount of time. But if there's 150 people doing it for me so I can make a decision, is a completely different story. So there's no golden egg. It's just literally they're doing the same thing, it's just at a bigger scale and more informed, right? I looked at EuroCAD, Euro Union, New Zealand dollar, and Euro AD. And what I see is like looking at the same chart. So I must just look at one of them. Yeah, although they have slightly different levels, there's obviously a correlation to all these pairs. Obviously, New Zealand dollar and AUD are going to be almost mirrors of each other all the time anyway, because the New Zealand dollar only works because of the AUD. New Zealand itself is basically nothing but a speck of dust in the middle of the ocean somewhere underneath a bigger continent. Don't tell New Zealanders that, but let's be honest, that's what it is. New Zealand feeds off Australia. If Australia does bad, New Zealand does bad. Right? So New Zealand and Australia are tied together. So the euro is tied to the AUD, is tied to the NZD. So they're going to almost be a mirror of each other. And this is a correlated exposure, right? So this again is why I say if you would take EuroCAD, Euro NZD, and Euro AUD, don't open the trade on all three of them, because you're taking the same risk on all three of them at the same time. You pick the one you like the most, and in this case, I would do either Euro, AUD, or EuroCAD. New Zealand dollar has a little bit of a funky ratio. Pick one that you like more, look at what it looks like, what you feel the most confident with, and trade it. And don't let anybody tell you what to do. If somebody comes like, no, you shouldn't trade that version, you should trade this one. Why? Right? Always make your own decision. Even if you have telesignals and all this kind of stuff, double analyze even what they gave you, make your own conclusion, make your own decision from there. It's your money, it's your trade, you're the one clicking the button. You need to be responsible for your trading. I hope that explains it, by the way, Marla. When can you be sure of something and maybe drop a standard? Well, Kevin, like we explained, like we analyzed, you can never be sure, and neither do we ever say it's guaranteed, right? It does not happen. But you can judge the high probability of something doing something. And when it comes to dropping a standard lot or more, it depends on your account. We just determined that once you've determined your entry point and you know where your stop loss is going to be, you calculate the distance between the two, and now you have a value that you can give a lot size to give it an actual value. You have a number that you can give a value, right? So let's say you have a $10,000 account, and we take the same scenario, right? So here, the EuroCAD that we did, right? So we go in here, my entry point is, my entry point is here, and my stop loss is here. I have a, let's say for ease, 100 pip stop loss, right? And I have a $10,000 account with a risk acceptance level of 5%. Right, so that makes sense now? Because now you basically do the same thing, right? You have a $500 stop loss, right? So this 100 pair would be 5 mini lots, basically. So even on 10 grand, you wouldn't be trading on a standard lot here. If you have 20 grand, you're now in the standard lot range. You would be one standard lot on this trade. You don't just randomly throw a standard lot in it because it means like, oh my God, look at how much profit I can make. Yeah, no, I don't care how much money I can make. I care about how much money I can lose, because that's the only side I'm trying to control. I've never heard any of my people complain about more profit. I've heard them complain about more loss though. No, Mamela, indicators are additional to your decision making on top of this. But again, this has to do with the crawling versus running thing. Like, learn how to crawl before you can walk, before you can run. Indicators and these kind of things all come in addition to having the fundamentals under your belt that they will then further help you judge when to go in. I hope that makes sense. So yes, you use indicators obviously on top of this. Once you get the basics down, you start adding, and this pushes you from winning 40%. Doing this will put you to about 50% rate, and then you start going to putting those indicators in to get past that point to make your account more and more and more and more profitable. But indicators are being misused in a lot of cases because people think that they are telling you what the market is going to do. They don't. They tell you what the market has done, and based on historic data, tell you what it could potentially start doing soon based on what the historical waves are doing, right? So let's take moving averages. Let's say a triple moving average. Let's say the top crosses the median and the bottom one starts turning away. It means that most likely it will turn because that was what it historically does. But the problem is an indicator uses historical data to make an algorithmic drawing of what it's going to do that you can control the variables of, by the way. So every different time frame should have different variables on top of that. That's beside the point, that's settings. The easiest way for me to explain this one is, let's say you have a glacier that has lasted for 300 years. Barely moving, just does the same thing. It moves between 2 and 5 centimeters a year. Now, tomorrow, a meteor strikes it, melts all the bloody thing, and it becomes a river. You now know that no longer it is a glacier. Something has fundamentally changed on the scenario that I'm trading in. The indicator would not. It's still calculating the 300 past years of history that it was a glacier. It has nothing to do with the trading scenario now. The market has shifted. You need to start from scratch, but an indicator can't do that. And this is where trading bots and everything else go wrong. Okay, I hope that explains it. Let me just pass on to the next one. What pair is best to trade through all? Can you suggest specific pair are the best to trade through all trade sessions? Okay, so Wally, again, this is very, very dependent. If you're a small account, stick to the majors. When you're a medium account, let's say 5 grand or up, look at some minors as well. And then when you start getting more confident and consistent, you start expanding into exotics, you start expanding into indices. Then when you have a large account of over 10,000, you start looking at a potential commodity here and there, one at a time. When you get over 50 grand of an account, you start looking at multiple, and then you really start building a portfolio. But before that, yeah, when you start as a starting trader, you should be doing majors only. And then you slowly transition into picking up some minors, and then you transition into exotics, like I said. Like that is the roadmap I would sketch anybody to start with. Commodities, indices, stock is something you do later, right? CFDs. That because the ratios are completely different there. Obviously, the markets move in a completely different way. It's much more fundamentally based. You need to be a lot more savvy and quick on your feet to do that properly. So you don't need to do any of those to trade properly as a retailer. It is purely as an additional tool to have access to. Okay, thanks. What's your name? Mike Rotting. Hold on, let me put it on the screen for you guys. We have to go back to start, don't we? Yeah. Okay, here, there you go. It's in the screen. Write it out. It's right there, that weird Dutchy thingy there in the bottom. Not the technical analysis, the part under it. All right. I hope you got that. Oops. What did I do? Did I go too fast? Yeah, I got. Oh, come on. Thank you. Q&A. Sorry. Right. Okay. So what's the next one? If you know the market is going to move to your resistance, why don't you buy? Okay. So Mabella, if you listen, when you have a small account, you don't trade against the trend because you just don't want that risk in case it does break out to the bottom, right? When you have a bigger account, you can risk that. So when you are confident in doing the sell at the top, sell at the top, sell at the top, and just keep going in, now to optimize it, you're going to do both ways. You're going to sell and then close at the bottom and then buy. So in this case, like the chart that we analyzed, yeah, I said, when you have a bigger account, you just buy it now. So your entry would be here where you are now. And now in this case, you have a little bit of a tricky situation because your stop loss should either be here, but then you don't have a good ratio. So here you're trading against the trend. The daily resistance is probably going to be somewhere over here. So you're going to do something like this. And then your take profit is going to be somewhere over here, right? Which is a 1-to-2 ratio, I think. 140. Yeah, almost. So the daily resistance is probably going to be somewhere here. But your percentage risk on this trade, because it's against the trend and the preferred direction is a sell, here you start changing your rule where you're going to go a 2.5% capital risk because it's against the direction. It is most likely going to do it, but it has the potential of a breakout because breakouts generally happen in direction of the trend, not against it, unless it's a swing. But then it usually corrects itself after that straight away, but that's beside the point, right? So here, here, if you would take the buy, you would take 2.5% risk of capital, and then you close it at the top and take the sell at the 5% capital acceptance, right? If that makes sense. Right, so the answer is yes, you do, when you're confident. And that's when you start optimizing your profits, optimizing your trading opportunities. But when, like, who was it? Kennedy said, like, when you have a small account, let's say you have $250, you cannot take these riskier trades. You need to focus on the bigger trades that are statistically just a much higher percentage chance of giving you a profitable trade, and just focus on those and take it slow. It's not about trading 50 trades a day or 100 trades a month. No, it's about picking the 2-3 good trades in a month that give you almost 6-7% return on investment each to grow the account exponentially. And then when you do lose, you lose 5%. Who cares? Right. So this is kind of the idea, right? You're taking 10-15%. Martingale strategy. No, I'm not going to get into that, Sean, now. Sorry. Every strategy obviously has its validities. Fishnet, zigzag, martingale, but yeah, no, it's too much complicated for me to get into. We're also past the time already, so. All I can say is there's validity to every strategy in specific market situations. Yeah. If that makes sense. I don't want to get too detailed into it.